I'm going to bring in now NatWest Markets, their U.S. head, Michelle Girard. Michelle, let's start here. Inflation expectations, because we know a couple of years ago, this same report, Michigan University had a spike in expectations for inflation. It spooked the Fed, and Powell took action. What do you think now the Fed's thinking when they see this number?
Well, I think that they are quite concerned because, of course, a lot of this reflects the expectations on tariffs, that tariffs are going to put more upward pressure on inflation than we've even seen. And, of course, for the Fed, if inflation expectations are rising, it's more likely that increases in prices become embedded. It's easier for companies, for example, to raise prices if consumers are sort of expecting higher prices. There's less pushback. If inflation expectations become unanchored, then it's really difficult for the Fed to rein that back in. It does require them down the road to get more aggressive. So they're very concerned. They don't want to see the kind of movements that we've been seeing. I think this is the third straight month that we've seen gains in the long-term inflation expectations reading of more than 0.5%. So I am sure it's got the Fed's attention.
Of course, Powell mentioned that during the Q&A, and I thought it was interesting. He slipped that in there. No one really caught it when he mentioned that the last time there were tariffs on household goods, washing machines, there were tariffs. Prices went up, but there were zero tariffs on dryers. And guess what? They hiked prices as well, and which is, a way of also, I think, taking a shot at corporate America. One thing that we also see, the Fed, Powell's got his own gauge, right? The Powell gauge. The 3-month moving average, this yellow line, is moving a lot faster than they want. Again, here's the 2% target. Moving in the wrong direction, certainly for Powell and company.
Yeah, I mean, the Fed's stance, often when we see kind of upticks in inflation is that it's transitory. But if inflation expectations are going up, it's more likely it won't be transitory. So as I said, this is certainly something that the Fed is watching. And I think it's also concerning because while we've got, fears about the economy slowing down, which, normally would mean that you might see less inflation pressure going forward. I think what we're seeing right now from consumers as well as, the worries in the market is that, you're worried about higher inflation and you're also worried about a recession.
Right.
So, a lot of times if you're worried about recession, it makes you less worried about prices staying high. But right now we're getting kind of unfortunately, the worst of both worlds.
Let's talk about the consumer for a moment. A couple of days ago, Bank of America put out their credit card information. What struck me is that some of these things have gotten a little bit better, right? So online electronics have gotten better. So the things that are red are still red, but not as red as they had been. For instance, entertainment down just a few days ago, down 15, down 11, down 8, down 6. I mean, it's hard to peg this consumer because, to your point, they are telling anyone who puts a clipboard in front of them that they're scared, but they go inside the mall and still spend money.
Well, Charles, you're so right. And as an economist, I've always been one to say, don't listen to what they say, watch what they do. And so far, they have been continuing to spend. Now, again, maybe they're out trying to buy goods that they're afraid are going to become higher priced going forward. I think the worry that we all have, of course, is that with consumer sentiment doing what it's doing. And in the report you were citing with the consumer sentiment, you've got 2/3 of consumers expecting the unemployment rate to be higher going forward. That's going to make them more conservative when it comes to spending. I think the other point that I'm not sure you touched on was the fact that we saw a big drop this month in sentiment among high-income consumers. And that's really who've been driving a lot of the strong spending over the last couple of years. So that's a bit worrisome. Again, the question is, do these poor survey results translate in, as I was talking about, weaker hard data? But this is the concern. The strength we saw this morning in actual spending may not be sustained going forward.
So let's talk about recession, stagflation. All of these things are floating around. Deutsche Bank just did a survey, and on average, 42, let's call it 43%, see a recession over the next 12 months. Of course, we've been here, seen that before, where it's been 100% not long ago. It didn't come to fruition. What's your modeling saying at this moment? I know it's tough because of all the moving parts, but what are you thinking?
It is. We're still in the kind of 20 to 25% range. I think one of the things we're cognizant of is the fact that, as you said, the market is digesting a lot of bad news, a lot of the more negative economic implications of Trump policies. But there are positives, and if you look ahead in terms of potential for tax cuts that will be coming, other areas that we'll see, like deregulation, that as that really starts to become much more embedded, you will see a benefit to the economy. I mean, right now, we're very focused on the more negative implications of all the actions that Trump is taking. It's a timing thing. But we do think over the second half of the year, some of the more positive aspects of the new administration's policies may show themselves. So we are still kind of in the 20 to 25% only recession probability camp.
Yeah, I'm with you there. I know it's frustrating for a lot of Trump fans that they didn't start with the easy stuff, or they're not messaging that stuff. But you know what? If you got to start off like this, you start off like it, you get it out there, and then the other things will come around. Michelle, we needed you today. Thank you so much. Appreciate it.
Thanks, Charles. Great to see you.
See you soon.